The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody. Good afternoon. This is Andrew Wilkinson. I'm the Director of Trading Education at Interactive Brokers, coming to you live from New York State. And I'm very pleased today. I'm joined by my colleague, Steve Levine, on the Traders Academy and Traders Insight team, along with Chris Morangi, the Portfolio Manager at Gabelli Funds, who's going to be addressing the very hot topic of ESG. And before I hand over to Steve, just a couple of pieces of housekeeping for everybody. Today's event's being recorded. If you registered, you're going to receive an email later this afternoon, probably 2 hours after the end of the event. And from there, you'll be able to click and watch the recording. It's going to be available on ibkrwebinars.com and on the IBKR YouTube channel. And I'd very much like to thank Gabelli Funds for participating in today's event. Chris, if I could ask you to forward to the disclosure slide, we'll put that up for a few seconds. I'd like to just draw people's attention to some of the risks associated with some of the discussion that we're going to have today. You can please ask questions. Use the GoToWebinar chat panel or the question panel just by expanding it, and direct your questions to Chris throughout the session. And then Steve and Chris will have a live Q&A at the end of the presentation. I'm hoping everybody can hear me okay. If somebody just wants to put a Y into the chat panel, just so A, you know where it's there, and B, we know that we can hear everybody. And I think I'm about ready to hand over to Steve Levine. But one thing I should mention before I do, there is a handout for today's event. So if you expand the handout section of the GoToWebinar panel, you will see a link to today's PDF put together by the folks at Gabelli Funds. Okay, I'm going to go on mute. Steve Levine, I'm going to hand over to you. Are you there, Steve?
I am here.
Who have you got on the line today, Steve?
Oh, we've got Chris Morangi at Gabelli Funds, portfolio manager there. Very, very exciting topic. I love the whole idea of ESG. We just did an entire Traders Academy course on ESG investing. It's been a huge disruptor of markets. I mean, certain markets have just completely transformed in the wake of ESG investing. At least that's what we found in our research. And today, Chris is going to talk about 3 hottest words in investing. So true, environmental, social, governance issues. Chris, can you tell us a little bit of something of what interests you in ESG and what we're going to hear today?
Great, thanks, Steve, and thanks, Andrew, and thanks to Interactive Brokers for hosting today. So very excited to talk about ESG. We've been involved in values-based investing for over 20 years at Gabelli, and we have an ESG fund and just launched a sustainability-focused ETF called Love Our Planet and People. I'm the lead portfolio manager on that product, and excited to talk more about it.
Oh, that's really terrific. Really terrific. Well, we're excited to hear what you have to say in the presentation. I'm looking forward to seeing it, and I know I'm sure our audience is too. So yeah, without further ado, great to hear what you have.
Terrific. So I obviously thought a little bit about this title, and those of a certain age will remember a classic George Carlin comedy skit called The 7 Words You Can't Say on TV. You can't say those words in webinars in 2021 either, but you can't get through an investment presentation without these 3 words. That's environmental, social, and governance. I'll keep this survey relatively brief and leave time for questions, but I'm going to start with some ESG history, discuss a little bit more about the specifics of ESG, and speculate a little on what the future of ESG might hold. Just quickly, background on our firm. I mentioned our CEO and one of my co-CIOs, Mario Gabelli, founded the firm in 1977, took it public in 99. Today we manage $33 billion on behalf of clients, mostly in our unique private market value with a catalyst approach, but also in growth, gold, merger arbitrage, and convertibles, and of course in ESG. And we've got, as I mentioned, separate accounts, mutual funds, and ETFs, all aggregating to about $600 million today. We've got a team. This is the team focused on it. I'm up in the upper right there. And we've got over 30 analysts who are integrating ESG factors into everything that they do. So in addition to the IBKR Academy, discussing ESG. It certainly appears not just in the financial press, but in the general media as well. And almost every company discusses it these days. I haven't read every annual report, but the hundreds that I have read, I'd say probably 9 out of 10 mentioned ESG in the chairman or CEO letter. And it's been a topic mentioned in a lot of Q1 calls as well. And that's reflected in funds flows with, by one measure, 17 trillion of 51 trillion of professionally managed money in the US, that's institutional, retail, debt, and equity, using ESG in some form. That's according to the US Sustainable Investing Foundation. And that's up from about 500 billion just 10 years ago. And this chart that I'm showing includes equity funds, but it illustrates the same trends, up and to the right by a lot. Separate discussion, but while there's been a reawakening of sorts on social issues, particularly as they relate to the environment, and particularly among the younger generation just now entering the investment mix, investing with a conscience really isn't a new idea. In fact, one can argue that it goes back thousands of years to the founding texts of the world's major religions. But in modern times, John Wesley, who was influential in the early Methodist Church, is credited with voicing the obligations that come with money, with investing, in his famous use of money sermon. And then in the 1970s and 80s, there were some significant divestment movements around apartheid, South Africa, Northern Ireland, and of course, increasing environmental awareness. And it was in this environment, and it coincided in part with the LBO boom and corporate rating, that we landed our first SRI, and I'll define that in a moment, mandate, and issued our Magna Carta of shareholder rights, laying out what we view as good governance principles. So SRI, as I mentioned, is an acronym for socially responsible investing. It's one flavor of what, again, I've called values-based investing, methodologies that explicitly consider more than just traditional valuation and economic returns analysis. Now, I've arrayed some of those flavors here based on the degree to which non-economic factors are usually considered, although it's not necessarily what defines each strategy. SRI was one of the earliest values-based strategies, and it's most often associated with religious mandates and negative screening. That is, we start with the full universe of investment candidates, eliminate objectionable activities like gambling, alcohol, weapons, etc., and construct a portfolio that maximizes returns for the least risk. ESG strategies often, but not always, screen out objectionable activities as well. For example, fossil fuel, very often nuclear weapons technology, but typically employ positive screens. That is, favoring companies that score well on certain criteria other than just growth and margins and other explicitly financial measures. Then you've got thematic investing, which really narrows down the criteria further to just a handful of ideas that are often encompassed by ESG, things like the environment or diversity, equity, inclusion. And then you've got the last circle there, which is direct impact investing, and usually that's associated with venture investing, where investments are made to support a particular mission, irrespective of financial returns. Now, obviously, there's a lot of overlap between these, and some actually conflict with one another. But for now, I'll focus on ESG. And here are some of the typical factors. Without much background, you could probably guess some of the criteria that get used in each of these categories. In the environmental world, it usually centers around how companies' manufacturing process and products impact greenhouse gas emissions, scarce resources, or long-lived wastes. There almost always is a polar bear in ESG presentations. And then social factors, you've got community and labor relations dynamics, as well as workforce inclusiveness. And then governance tends to be the most concrete. It's the most widely accepted and probably the oldest of these factors that gets considered. There's been a cottage industry of proxy advisory firms, consultants, and activists around for many decades advocating for things like board declassification, chairman CEO separation, compensation alignment, et cetera, many of which are included in our Magna Carta shareholder rights that I mentioned. Now, there's also a cottage industry of ESG organizations, and these are just a few of those you might encounter. Everything from ESG evaluation firms like Sustainalytics, MSCI, and Morningstar, to standard setters like the SASB and the PRI, which is a UN-sponsored document of which we and many other investment firms are signatories, specifying essentially what we favor and what we oppose on the ESG front. And although it doesn't negate the concept, it's worth noting that ESG is a big business for a lot of firms, and including a lot of investment firms. So just something to keep in mind. ESG objectives. So why use ESG? Again, there's a spectrum of objectives. It varies by investor, but at one end, you've got investors who are explicitly attempting to alter consumer behavior by influencing fund flows. Now, in theory, if money goes to highly rated ESG firms, the higher their multiples go and the higher their stock prices go, and the lower their cost of capital to fund their business, make acquisitions, et cetera. The reverse would also be true. At the other end of the spectrum are investors who are attempting to identify data that could indicate whether a company is advantaged or at risk from their own corporate behavior or from secular shifts among communities or the environment. Somewhere in the middle are investors who simply don't want to support the activities that they find objectionable with their hard-earned savings. And of course, none of those objectives are mutually exclusive. So what does the data say about ESG-friendly firms? Do they actually perform better, or is this just made-up marketing? Well, there's a lot of data out there, and it comes with a lot of caveats, but it would seem that there is, in fact, a positive correlation between scoring high on ESG and performing well as a business, financial measures, and as a stock. The business school at NYU published a meta-study of over 1,000 individual studies suggesting that much. This was just under a year ago. And there's been a lot of data suggesting that ESG funds outperform their non-ESG peers and sometimes the market. But clearly needs to be more work done. And one of the caveats that may become evident is when you look at a composite of the top holdings of US ESG funds. A lot of ESG funds turn out to be mega cap tech funds in disguise. Those mega cap tech companies have done quite well, obviously, over the last 5 years. And many of them are very highly rated when it comes to ESG because they generally don't pollute directly, and they often embrace very forward-looking social policies. But those with long memories and a keen eye may question why companies with dominant market power, an intersection with consumer privacy, and issues with labor and a reliance on energy-gobbling data centers belong on this list. I'm looking at you, Microsoft, Apple, Amazon, and Google. Many of these are judgment calls, which brings up some issues with ESG, which is why ESG remains a work in process. Namely, we don't have universal standards for what it means to be ESG. There are objective measures of economic returns, and again, a good understanding of what board best practices look like. But in many cases, we don't even have the data by which to evaluate these factors. Now, notably, this is changing. Pick up any recent annual report, as I mentioned at the outset of this webinar, and you'll see some highlights of a firm's carbon footprint, maybe some highlights of their supply chain safety and diversity steps that they're taking. It's probably for the better that authorities are getting involved with ESG. ESG disclosure is a key priority, in fact, for the Biden SEC, and there's clearly more to come there. Again, all a work in process. So I can opine on a few potential directions for the future of ESG. One thing we're seeing is an integration, a melting away of ESG analysis into standard financial analysis. And ESG really has become table stakes in the institutional investment world. And I think that probably will be the case when it comes to retail as well. At the same time, I think you're seeing some more focused ESG funds out there, funds with more measurable objectives in things like sustainability, again, DEI, and in many cases, religious or philosophical preferences, again, going back to the early SRI days. And I'll talk for the rest of the webinar about one of these themes, one that we're focused on, and that's, of course, sustainability, another hot word, and one that doesn't need a whole lot of introduction. Certainly, there are plenty of books and plenty of news coverage about what's going on here, and a lot of investment themes to pick on. One of the most prominent in our view is water, and the dynamics here are pretty obvious. The amount of fixed water in the world is just flattish, perhaps going down, and population is going up, and all of this is being exacerbated by global warming. So there's an opportunity to invest in that. This is just one group of companies in the water ecosystem. Xylem, which is one of the larger players here, is that their tagline is, in fact, let's solve water, and that's what they're trying to do. Waste reduction is another theme. I even remember the days of the 3 R's: reduce, recycle, reuse, and it's gone beyond that. There's a real focus on reducing plastics, which are long-lived and clog up our waterways. And some of that is, frankly, economically driven with some changes in the flow of waste around the world. And you've got, again, another robust ecosystem here with companies that are packaging companies that are moving towards aluminum cans, which are 100% recyclable, and finding biodegradable or recyclable plastic. Certainly, clean mobility is a hot theme amongst ESG funds, and it goes beyond, of course, just Tesla. Here we're talking about not just electric cars, but battery-powered cars, but cars that increasingly are going to be powered by hydrogen, and that's probably going to happen with trucks first, and the entire ecosystem that needs to exist to replace the ecosystem that supports the internal combustion engine. That's everything from batteries and charging networks to the car parts and equipment that go into those, as well as, of course, the assemblers of those vehicles. And of course, this revolution is going to be powered by electricity, but it's not going to be powered by fossil fuels increasingly over time. You can see the change in mix here, both through state-mandated targets on electricity generation, as well as commitments made by individual companies themselves. We're going to see over time much more than half of the total energy mix in the U.S. Come from renewable sources. And again, lots of ways to profit from this by owning not just the equipment companies and the service companies, but also the utilities themselves, which are certainly not your mother or father's utilities. Increasingly, many of these companies are being very aggressive about the shift to wind and solar. So, I think what you can take away from all this is that there's really an opportunity for supporting profits and people. In fact, we think that they are mutually reinforcing. The greatest profit opportunity is if we have a prosperous and planet going forward, and so we don't think that's a platitude, and it's something that we believe in here, and we think is here to stay with some continued evolution. So we're happy to be part of it, and LOP is just one of our signs of commitment, and we have offered that actually for the first year with no fees to demonstrate our commitment. So with that, I'm happy to take questions from the audience.
Well, that's terrific, Chris. We have lots of questions that have already come in from the audience, it looks like, and I don't know if you can see them on your panel, but one comes from Vince Donovan, who's asking about the new book on the environment by Stephen Koonin. I'm not completely familiar with this book, but I assume it has something to do with climate or climate change, and whether it is resolved.
Well, certainly not resolved. I haven't gotten to that particular book. There's plenty of books to read on this. I recommend Bill Gates' latest tome on it. Don't necessarily agree with all of his conclusions, but he is someone who has spent a lot of time studying this issue and has some, I think, reasonable solutions here. I think the key is to be pragmatic about these things, and also to take a broad view of the world. There's things that each of us as individuals can do, the way we live our lives, the way we invest our money. But clearly governments need to get involved, both local, state, federal agencies in the US. And this is a global effort. Obviously, there are no barriers between the US and other countries, and this will take global coordination over probably many decades. But I do think, and I am hopeful that it is actually an issue that we can tackle. And in my own view, a lot of this will be tackled through the ingenuity of individuals and companies out there who are advancing technology to deal with some of the things that have happened in the past.
Yes. It's really fascinating, the directions things are taking. Based on the information that's presented to us one way or the other, there seems to be a pressing need. We have another question from Vijanjali Lotan. I don't know if I'm pronouncing that right. And Vijanjali asks, do we have resources to be able to also analyze the supply chain's ESG considerations when evaluating a company? And there's a second part to this. For instance, a company might have great ESG ratings and we would be inclined to invest in those, but it could be that their supply chain, smaller, less transparent companies may have bad ratings, and thus investing in such companies could negate the positive effects.
Yeah, it's a great question. And this comes up very often with regard to some of the large tech companies, tech hardware companies in particular, that outsource the manufacture of their goods. Apple would be the obvious example, which had some issues a few years ago in particular with some of the conditions that the individuals who were selling iPhones worked in. And to their credit, Apple and others, and this is not exclusive to tech. There are companies in other industries. Nestle comes to mind, which sources chocolate from Africa, cocoa from Africa, and there have been historically some issues with that. But a lot of these larger companies have put great effort into making sure that their supply chains are, their suppliers are playing by the rules and ensuring that those who are involved can make a livable wage and who are not polluting the environment. So clearly, there's always a need for more transparency and more information, but in many cases we are relying on the self-report of these large organizations and evaluating it from that standpoint.
Yeah, that's terrific. That's really terrific. We have a lot of questions coming in, Chris, so I hope we've got the time for all of these. We've got another from Nitesh Wazin. I don't know, again, if I'm pronouncing that right, so my apologies to all of you whose names I'm not pronouncing very well. But what about water futures and the water markets or water futures?
Yeah, this goes back to, again, the idea of trying to use markets, capitalism, frankly, to address externalities in the economy. And one of those is, of course, who owns water. Probably the most developed environmental related market are carbon markets, which are more developed outside the United States, but are coming here. But water markets are also developing. Water rights are obviously a very old system in some parts of the country, particularly the American West, the Colorado River, and there are some companies that have water rights that are publicly traded that maybe could have some hidden value in them. Again, something that we're looking at, nascent, much more work to be done.
Yes. I'm going to keep going with these questions, Chris. I hope this works okay for you.
That's great. Keep
okay.
coming.
Yeah, there's a lot of interest, and we can see that. What is the easiest way to get involved with LOPP? Asks George Sakel.
I like that question. Yeah, so so LOP is an exchange traded fund. We historically have been a mutual fund issuer, but a LOP was our first actively traded semi-transparent ETF. So we can bring our ideas to the marketplace in the form of an ETF, which are exchange traded, easy to use, and you could buy it at IBKR today.
Yes. Yes.
And the stock, it's LOPP is the symbol. It's trading around 27.40.
And it's an ETF.
Correct. It's an ETF, which has all the benefits of lower cost and tax efficiency and things like that. And as I mentioned, actually for the first year at least, no fees.
I see. I see. This next question comes from a Clay Montgomery, who asks whether you consider nuclear power as green.
So it's a great question, and one we get often. It's a controversial one. It's certainly controversial in the ESG world. So my own view, and I believe this is the view of Bill Gates too, if you read his book, is that if your goal is to reduce greenhouse gases, practically the only way to do that in the short term is to include a significant nuclear component in your electricity generation mix. And that's because obviously it doesn't pollute the atmosphere, at least directly, and it is a reliable fuel that can provide a reliable baseload generation when the wind doesn't blow and the sun doesn't shine, and batteries aren't available to store that energy. Obviously, there is a contrary view, which is that that the process of mining and refining uranium is very polluting, and that obviously having nuclear generating stations in your population centers could lead to human catastrophe, as we saw to some extent with Chernobyl, obviously, and then later with Fukushima. Obviously, the human component there was at least limited in the near term, but the long-term impact of Fukushima on the environment, and particularly since it was located near the Pacific, is, I guess, to be fully determined. So we actually don't own. We have chosen in LOP not to own nuclear, and it's a little bit of a cop-out because there just aren't a lot of ways to play nuclear directly in the public markets. There are public uranium miners. There are companies that make equipment for nuclear power plants. Tends to be a smaller part of larger businesses. So we have actually, it was kind of an easy decision for us just to not even get involved in that debate and exclude it. If I could just expand on that question a little bit, because a related question we get is, can an integrated oil company be considered ESG or be included in an ESG fund? And it's a similar answer there. Some have basically taken the decision that one can own in an ESG fund the relatively highly scored ESG integrated oil firms. So obviously, the large fossil fuel companies are approaching the problem of climate change differently. Some would say more aggressively than others, and you can justify owning, say, BP, but not Exxon, as a for instance. Again, we have tried to remain pure in LOP and in our ESG fund, where we don't own any fossil fuel related companies. But again, open to interpretation, and certainly a valid debate.
Oh, it's terrific. It's terrific. We have a few more here for you, Chris. This next one has to do with ESG scoring, and IBKR also has a scoring system on its platform to rate ESG companies. But the question here is, what is a good ESG score for a company?
Yeah, so obviously it depends what grading system you're using, and the rating firms that I mentioned on that earlier slide have different systems. Morningstar uses globes, Sustainalytics, gives grades, as is MSCI, which gives AAA to D grades for each individual company. We subscribe to MSCI, and you'll get different answers from different firms. We subscribe to MSCI. We're generally looking for A-rated or better companies, but it's important to note that we also rely on our own internal ratings and judgment. A lot of investment firms charge their analysts with doing their own work and researching these issues, which we do because we think we've got a very good view from our fundamental financial work on these companies as to their approach to some of these ESG issues, and so we rely on some qualitative judgments from our analysts to make our own judgments about a company's ESG qualifications.
That's very good, very good. Juan Ribeiro comes to us. He asks, ESG may increase returns, but what is its drive on the investment risk or volatility?
Yeah, so I haven't looked at that specifically. In theory, one would think that it would reduce risk. And certainly, that's part of one of the objectives of looking at ESG is to look at what may not be obvious kind of long-tail risks in a company's outlook. Long-term environmental liabilities, shortages of inputs, labor problems that may not emerge for years, those kinds of things. And I think ESG will actually prove very helpful in that regard, and sort of broadening the aperture of things that we look at as financial analysts. As far as risk defined as it often is in kind of modern finance as volatility, again, I don't know this for a fact, but I'm going to guess that it probably reduces volatility simply because you have fewer commodity-related firms. One of the good things about being in ESG generally over the last few years has been you've avoided the collapse of energy prices and the impact there. Now, depending on what happens to energy prices going forward, and I think they're going up, that you may be missing out on some potential returns, to be clear. But it probably, in general, dealing with less volatile financial returns.
It's really terrific. I actually have a follow-up to that for myself, because I'm very interested in this as well. If that's okay, I'm looking at, say, for example, green bonds or social bonds, where uses of proceeds are going towards projects that are say unprecedented in the way that they're being constructed, either for major wind or solar to replace conventional energy in some countries, et cetera. But how would you measure the risk for projects that are very new in terms of scope and objective?
Well, it's no different than looking at a company that has a new product or service, and obviously you can make a forecast, and generally we don't come up with forecasts, we come up with ranges, or we come up with a variety of scenarios for how a project might play out, and then you've got to price that. And in general, if there's greater uncertainty around the returns of a project, you'd want a greater return, and so you demand, in our world, in the value investing world, a larger margin of safety or a larger discount to whatever you think the private market value or the intrinsic value might be, and that's sort of how we look at it. One of the benefits of being involved in some of these, particularly generation and transportation projects that often get financed with green bonds, is that they're either implicitly or explicitly backed by government or very highly rated entities like utilities. So they tend to be kind of lower risk infrastructure type projects.
Yeah, yeah, it's great. I mean, there's been such a proliferation of those. It's been amazing. Okay, moving on. Roman Emminger, Roman Emminger, sorry. What is your opinion on the regulatory developments in the EU related to sustainable finance, EU action plan or sustainable finance? Shall the definition of sustainable activities be provided by the regulator?
Yeah, so the EU is, like, depending on your point of view, a few years ahead of the United States in terms of their aggressiveness in regulating ESG funds and defining all these things. I do think that there has to be a sheriff, even though I am personally personal big believer in free markets and et cetera, do accept that there needs to be a sheriff in town to maintain order and to protect the little guy. And I think, to their credit, that's what regulators in general are trying to do. So I don't think it's a bad thing. I think in general, transparency is the best disinfectant, and if we can, as a community, increase the amount of information that if companies can increase the amount of information they share with investors and professional money managers like us share more information with our clients and investors, we'll all be better off. I think we try to be as transparent as possible with our investors, which is why we have certain rules like no fossil fuels, for example. I think there are some people who might be surprised to learn that their ESG funds own Exxon, for example, as many do. So do your homework, but also incumbent upon the players in the market to be transparent about what they're doing.
Yeah, it's great. Really fascinating stuff. Let's see. Brad Merkel, can you comment on the effectiveness of negative screening versus positive screening in managing a large diversified portfolio? For example, a large pension fund.
Yeah. So the I don't know that I've actually seen any statistical analysis of that compares negative to positive screening. Obviously, negative screening is easier to do. It's a bit more concrete. You know the activities that you want to prohibit. It's a little less clear what activities you want to encourage. So a lot of these screened companies tend to be in defense, gambling, alcohol, tobacco, obviously. So those are the big ones, and those have generally not been the highest return sectors in the market over the last decade or so. Notably, obviously, technology almost never gets screened out, nor do a lot of consumer companies. So our experience has been that investors have really not sacrificed return in the negative screen world. I think, again, as I discussed earlier, it's an open question as to how much return you can gain from positive screens.
We have just a few left here, Chris. It's so much interest, so much involvement in the space. It's really great to see. Yang Qian asks, would you say that the trend of increasing focus on ESG would actually accelerate outsourcing?
Outsourcing of I guess I'm not sure if the question relates to outsourcing of investment management or outsourcing by individual companies. I guess I'll comment on both. I think it actually, and relate it back to what was, I think, the second question on supply chains, which is that just because a company doesn't directly engage in activities which may put them at ESG risk doesn't mean that they're not responsible for those risks. In other words, Just because Apple doesn't actually employ people that make assemble phones doesn't absolve them from making sure those workers are not treated well. If that was the gist of the question. If the gist of the question was about outsourcing fund management, I think this is actually, I think ESG in many ways is a godsend for active managers, because it's an opportunity for active managers to leverage their knowledge about individual companies, and because no matter how much information comes out and how many quantitative measures there are, ESG is really a judgment call. It is not purely objective, and it's hard to see how it would be purely objective and able to be translated into a purely passive product. Obviously, there are plenty of passive ETFs out there, but plenty of passive ESG ETFs out there. But I think human involvement is even more critical when it comes to making ESG judgments, and that's good for active management.
Oh, okay. Well, good. We're moving down the line here. Pedro Enrique Mendoza asks, does law pay a dividend, or does income come from the price fluctuation?
Yeah. So it at the moment it does not. That obviously could change over time, but there is not. This is not an income-oriented product.
Got it. How do you address the disconnect between short-term return versus short-term return and or performance versus long-term ESG impacts of a portfolio?
Yeah, well, I guess I'm not sure that there is a disconnect. Like anything, we take a long-term view, and what is long-term is always the question, but call it through a market cycle. So, a company may make investments, add to operating expenses, et cetera, to ensure that they're a highly performing ESG company, and that I think companies expect would pay dividends over a longer period of time, to the extent, as I mentioned, that there's a supply chain issue or shortage, or the laws change, which make some environmental activity that was once legal now illegal. And so yes, there is a little bit of a time arbitrage there, but again, the market is forward-looking, and we as investors think about all those risks and hopefully reward the companies that are thinking about those risks as well in returns today.
Yes. This we have one final question here from George Sakel, and it involves wind and the environment. And I've heard this question before, actually, and it's interesting. Are you seeing any pushback against such large investment in wind energy due to the environmental costs associated with building the wind generators and batteries, while wind has a rather limited maximum theoretical efficiency and output? So I guess in short, are the results going to be worth the cost of the danger to the environment, or potential danger?
Right, and you could extend this question to solar as well, and solar uses some nasty materials in making photovoltaic cells. Also takes up a lot of land. Covers significant real estate, and frankly is been known to fry some birds and insects, just like wind turbines have led to the demise of many birds. So listen, I think like anything, ESG is about trade-offs, and we have a world today that is very imperfect. That fossil fuel generation has a lot of positives that go for it: energy density, availability, and an existing infrastructure, for instance, but obviously has lots of negatives, including foremost amongst them, greenhouse gas emissions. So, how do we, what are we trying to solve for? How do we mitigate some of those negatives without losing some of the positives? And there's no perfect substitute, but we try to overall increase the energy efficiency of the system and reduce the environmental impact of the system, and that involves a variety of tools to do it. And those I think include things like solar and wind and probably nuclear in my view, as well as I think some natural gas fired plants for the foreseeable future to provide that reliable base load, particularly in parts of the country where renewable power is not necessarily available. So again, there's not one silver bullet, but I am actually very hopeful in the steps that are being taken around the world, and what companies are doing, and especially the enthusiasm that we're seeing amongst younger generations and young investors and wanting to get involved and support the ecosystem of the future. And I'm glad to be a part of it.
Yeah, it's on that note, Chris, I mean, it certainly is a really transforming type of discipline in terms of how markets are producing products, et cetera. You see what's happening in transportation with electric vehicles. You see what's happening in food manufacturing with dairy completely being replaced almost completely being replaced. It's really decimating, say, unfortunately, the dairy farms of America with plant-based foods or plant-based beef. There's quite a number of different market sectors that are showing innovation like I haven't seen, since I guess the VCR came out, which dates me. But yeah, I mean, the way that technology is being introduced into healthcare, into transportation again. Energy itself is undergoing so much transformation. I mean, for lack of a better word, I know that word's been hyped a lot in terms of energy. So I mean, I can't imagine seeing the same world that I grew up in the next, say, 20 years or 30 years. I mean, do you think that consumers are really going to be faced with a completely different experience in terms of their lifestyles and behaviors?
Yeah, I think listen, again, just drawing on anecdata, my personal experience is yes, I have 4 children ranging in age from 5 to 17, and even within them, there's a very different view of the world. Obviously, all impacted by what we've gone through over the last year plus in terms of the pandemic. But yeah, this is the younger generation, my teenagers, have different expectations and really are very passionate about their communities and the environment in a way that I think we haven't seen in this country ever, perhaps. So yeah, I think we are living in a different world. I think one other just interesting thing that I'd want to point out is that from an investment perspective, is that we're seeing, I think probably one of the most interesting things we're seeing in our investment universe are sort of traditional companies pivoting to this new world and really actively, and in many cases aggressively, changing their business models to adapt to this new world. That's everything from, General Motors, which has certainly been a beneficiary for over a century of the internal combustion engine, basically committing to carbon neutrality in the next decade plus, and moving their business to electric vehicles, et cetera. And there are lots of examples of that across the spectrum, and those are the kind of companies that we're really focused on, because I think, you know, in many cases, this innovation, this transformation, as you call it, is going to be led by the leaders of the past. Not in all cases. There's certainly going to be a lot of new companies out there who are exciting and doing exciting things as well. But you know, we're seeing creative destruction on a scale that we haven't seen for decades.
Yeah, absolutely. I mean, absolutely. And if those companies are built to last, yeah, they'll certainly adapt to you know, where they're finding consumption desire, I suppose, for lack of better words. If people are gravitating more and more towards the trends that, and I don't want to say trends, but really embedded lifestyle types of behaviors, then there's going to be a natural gravitation towards those new products, it seems. And those companies will have to adapt or be phased out, I suppose, for lack of demand. It's really incredible, and I guess on a last point, at least, you know, from my perspective, there's a lot of companies also that seem to be marketing themselves as being, and I think you mentioned it in your presentation as well, aligned with ESG trends within their operations, but they're really not. They may market their fuel, and I know there was an Italian company, I think Eni, who marketed biodiesel fuel that was killing wildlife in the Amazon, and they were saying it was green, and they were slapped with a huge fine, I think, if I'm not wrong about that. So there's a lot of, I guess, greenwashing and other types of washing types of activities going on. Is there any way for people to be on guard for this? I know they would need to do their homework and their due diligence into it, but would you suggest that there's any other red flags that they might watch out for, that, you know, if they really want these companies to be aligned with their values and they're not, but they say they are? How do you identify these potential false perceptions? Can you?
Yeah, it's a great question. And listen, you know, this is not all that different than, you know, holding companies accountable for promises they make or projections that they make on the financial front. You know, companies, you know, talk about their new products and how popular they're amongst consumers all the time, as a for instance. And sometimes that's not true, and sometimes it's not, you know, a nefarious activity by executives or the company. It may just be a misperception or miscommunication or something like that. So, you know, we as investors have to do our work, have to basically trust but verify everything that management says, and that involves you're talking to lots of different people in the ecosystem, consumers, competitors, suppliers, etc., to get a better view as to, you know, whether these what companies say they're doing is really true.
Yeah, it comes, a lot of this, it seems, comes down to a great amount of due diligence to know the company, and to really get a sense for its values in the due diligence that you dive into. It's amazing. It's really fascinating. Chris, thank you so much. I think we have exhausted the questions in our question board, but is there anything else that you'd like to say?
No, listen, there were some really great questions there. Actually, very excited that there's so much interest and they get such passion for the environment and in other issues, and that's exactly why we launched LOP and are so supportive of ESG, and are very much looking forward to, you know, seeing it evolve as it will over time. So again, thank you, Steve, and thank IBKR for their support.
Well, really lucky to have had you here. Thank you so much, and to the audience as well. Just as a reminder, you'll receive a link to the recorded of this event, the recording of the event, in roughly 2 hours. So look out for that in your inbox. Again, Chris, thank you so much. We hope to have you back and with further insights into the ESG world.
Have a great day.
You too. Thanks so much. Thank you.